Welcome to the Deep Dive, where we really try to cut through the noise and get you properly informed. Today, we're diving into something that's, well, just vital for Canada's 86,000 plus registered charities. We're talking CRA compliance. All the amazing work they do feeding people, environmental work, research, you name it, it all hinges on something maybe less exciting, but totally crucial, staying on the right side of the Canada Revenue Agency. So, our mission today: navigate the, let's face it, often tricky world of CRA compliance for these charities. We want to make sure you understand how to stay in good standing, steer clear of the common problems, and just keep doing the essential work charities do. We've got a great source to guide us, a really comprehensive expert FAQ focused specifically on maintaining a charity's good standing. So yeah, expect practical tips, actionable stuff, and maybe a few surprises along the way. Okay, so let's unpack this. When we talk CRA compliance for charities, it really starts with the Charities Directorate, doesn't it? Who exactly are they, and why are they so important for the whole charitable sector in Canada?
That's exactly the right place to begin. The Charities Directorate is, well, it's the specific arm of the CRA that handles everything charity related. You can think of them as the gatekeepers, but also the guides, in a way, their main jobs. Reviewing applications for charity status, providing guidance, lots of education, actually and critically monitoring compliance with the Income Tax Act. They're also the ones doing audits, applying penalties if needed, developing policy around charities, and keeping that public list of all registered charities. So it's this sort of dual role. Enforcement, yes, but balanced with education and support. They really aim to encourage voluntary compliance.
86,000 charities. That's a huge number.
Yeah.
How does the CRA actually manage to keep tabs on all of them? I mean, beyond just looking at the annual filings, what other ways do they monitor compliance?
Yeah, it's definitely a multi-pronged approach and maybe more strategic than folks realize. Obviously, it starts with screening those annual T3010 returns. They look for errors, inconsistencies, red flags. But beyond that, they use risk-based audits targeting charities that seem to have higher risk indicators.
Okay.
They also do random audits just to get a sense of general compliance levels.
Yeah.
And this is a big one. They follow up on complaints. So concerns raised by the public or other agencies can trigger a review.
Right. Complaints matter.
They do. Plus, they'll do follow-up monitoring if a charity has had issues before. They even keep an eye on media reports about charities. And increasingly, data analysis helps them spot weird patterns in filings across the sector. It's all about using their resources effectively, right? Which brings up a good point. What are those common triggers? What makes the CRA decide to take a closer look?
Yeah, looking at that list of common triggers, some are pretty obvious, maybe, like filing your T3010 late or not completely filling it out. That's almost asking for attention. But it's not just missing info. They look at big jumps or drops in finances year over year, or if the activities you report suddenly seem, well, disconnected from your official charitable purpose. High fundraising costs compared to program spending, that can be a flag. Or unusual deals with directors or related folks. And something that might surprise people is how seriously they take public complaints, or even just getting caught up in public controversies. And then there are the big ones: operating outside your approved purposes, messing up donation receipts, or doing international work without really solid controls. All major triggers.
Absolutely. And if you connect that back, understanding those triggers is really all about prevention, isn't it? And it's worth remembering the CRA generally tries to take an education-first approach.
Really? Education first.
Surprisingly often, yeah. Their first step is often trying to help charities understand the rules. They put out a ton of guidance materials, webinars you can even call for advice, that actually rather use something like a compliance agreement to fix issues instead of jumping straight to penalties. They give charities a chance to correct minor stuff. It's usually only when things are serious or it keeps happening that they bring out the heavy sanctions. They'll explain their concerns in writing and usually give a reasonable amount of time to fix things, especially if they see you're trying in good faith.
Okay, this is where it gets really practical. The annual T3010 information return. This thing is basically your charity's yearly check-in with the CRA. It summarizes finances, activities, everything. It is, hands down, your single most important compliance task. Every single registered charity has to file this Form T3010, the Registered Charity Information Return, every year. And the deadline, crucial. It's due within 6 months after your fiscal year ends. 6 months.
Exactly. And that deadline covers everything, the main form, all the attachments, the schedules.
And no automatic extensions, right? Unless there's a major natural disaster.
Pretty much. You can still file on paper, but they really prefer electronic filing now. It's faster, more efficient for everyone.
So the big takeaway: Mark that date, put it in the calendar, set reminders way ahead of time. Don't miss it.
And getting that filing complete is key. It's
Yeah.
comprehensive, and honestly, it's where a lot of charities stumble. So
Yeah.
beyond the main T3010 form itself, you absolutely need your financial statements. And people forget this. The notes that go with those statements, very important.
Okay, the notes too.
Definitely. Then, depending on what your charity actually does, you'll need specific schedules, like working internationally. Schedule 2 is a must. Paying your directors or trustees. Schedule 3, got non-cash gifts. Schedule 5. There's also Form T1235, that's the Directors Trustees Worksheet, and T1236, the Qualified Donees Worksheet, but only if you gave money to other registered charities or qualified donees. The point isn't to memorize form numbers, is understanding which ones apply to your specific situation and making sure you use the latest versions, because they do update them.
That's a lot of detail to track. And even knowing all that, you said charities still make mistakes. What are some of the most common errors you see tripping organizations up on the T3010?
It often comes down to a few things, really. Basic math errors, believe it or not.
Yeah.
Or inconsistencies between different parts of the return. A really big one is just not reporting all your income or all your expenses, or having numbers on the T3010 that don't match your actual financial statements.
Okay. Consistency.
Exactly.
Yeah.
Missing director info is common too, or just forgetting the signature. Another one is describing activities that don't quite line up with the charitable purposes the CRA has on file for you. Or maybe misclassifying expenses, calling something program spending when it's really admin. These aren't always like deliberate mistakes. Often they just show gaps in internal checks and balances.
So, okay, let's say you do miss that deadline, or you file, but it's incomplete. What actually happens then? What are the real consequences?
Oh, they're serious,
Yeah.
and they escalate pretty fast. First, you'll probably get a reminder letter. Ignore that or still don't file correctly, and it can ramp up to a notice of intention to revoke. And that means your charitable status is genuinely at risk.
Revocation. Wow.
Yeah, and you mentioned that stat earlier, about 1,000 charities lose their registration every year, mainly for not filing the T3010. That's not trivial. It shows how fundamental the CRA sees this reporting.
So what happens if you are revoked?
Well, you get publicly listed as non-compliant, which isn't great for reputation, and getting re-registered, really tough, sometimes almost impossible. Plus, while you're non-compliant or revoked, you absolutely cannot issue official donation receipts. Big problem for fundraising. And in the worst-case scenario, especially after revocation, they can hit you with a revocation tax. It can be up to 100% of whatever assets you have left.
Ouch. 100%.
It's a pretty stark reminder. Even charities with great missions can get tripped up on the basics, and the results can be, well, devastating.
Okay, moving beyond the filing itself. Good financial management is obviously huge for CRA compliance. And that really starts with keeping proper books and records, right? We're talking complete records of every transaction, records that let you verify every single donation receipt you issue, clear tracking of what you spend on charitable programs versus admin or fundraising.
Absolutely. You need proof for all your income sources, records of your assets, your liabilities, board-approved budgets, the works.
And these records need to be kept where? And for how long?
At your registered address, usually, or another location if the CRA approves it.
Mm-hmm.
And the minimum retention period is 6 years after the end of the fiscal year they relate to. 6 years minimum. And speaking of finances, there's this thing called the disbursement quota. It's often misunderstood, but really important.
Right, the disbursement quota, what exactly is that?
It's basically a rule that says charities have to spend a minimum amount each year on their actual charitable work or on gifts to other qualified charities.
Mm-hmm.
Right now, the rate is 3.5% of the average value of your property that's not being used directly for charitable activities or administration.
Okay, 3.5% of assets not used for the mission.
Pretty much. Though there are thresholds, it generally applies if that property value is over $25,000 for charitable organizations or $100,000 for foundations.
Yeah.
And they calculate that average value based on the 24 months before the fiscal year starts.
Is there any flexibility there?
There is some, yeah. If you spend more than the quota 1 year, you can carry that excess forward for 5 years to cover future shortfalls. And if you have a shortfall, you can use excess spending from the past 5 years to cover it. The whole point is to make sure funds are actually being put to work for the charitable purpose, not just piling up indefinitely.
Makes sense. So staying on spending, what does the CRA consider acceptable spending versus unacceptable? Can you give us some clear examples?
Sure. Acceptable is usually pretty straightforward. Direct program costs, that's your core mission stuff, reasonable admin expenses needed to run the charity, necessary fundraising costs,
Okay.
gifts to other qualified donees like other registered charities, absolutely acceptable. Program-related investments can be too, and buying capital assets you use directly for your charity work.
Again, the unacceptable side.
That's where you need to be really careful. Any personal benefit to members, directors, staff, big no-no. Spending money on activities that aren't actually part of your charitable purpose. Political contributions or partisan activities, absolutely forbidden. Giving money to organizations that aren't qualified donees, unless you maintain strict direction and control over how it's used, we can talk more about that.
Right.
Also, just excessive or unreasonable spending in any category, or hoarding funds way beyond what you reasonably need for upcoming work. That could be flagged too. The bottom line for every expense has to be, how does this clearly support our registered charitable purpose?
Got it. And does that apply to investments too?
Yes, it does. Charities need to invest prudently, following relevant laws like trust or corporate law. And crucially, investments can't be made primarily to benefit, say, a director or someone related to the charity. Private foundations have even stricter rules about holding interests in businesses. Plus, you need to track the returns on investments, because that feeds into your disbursement quota calculation. Best practice. Have a clear investment policy, approved by your board, that ensures everything aligns with your mission.
Okay, let's shift gears to donation receipts. Issuing those is a huge benefit of being a registered charity, but you said the rules are really strict. What absolutely has to be on an official donation or receipt? There's quite a list, isn't there? You need that statement. Official receipt for income tax purposes. The charity's name and address as registered with CRA, your registration number. A unique serial number for the receipt.
Yep, all those. Plus, where the receipt was issued, the date the donation was made, and the date the receipt was issued, if they're different.
Donor's full name and address. The amount of a cash gift, if it's not cash, like donated property, a description, and the fair market value.
Correct. And don't forget the CRA's name and website address has to be on there too.
Right. And the name and signature of someone authorized by the charity to issue receipts. And this is the one you said trips people up the value and description of any advantage the donor received in return for the gift.
Exactly. That advantage piece is critical. If the donor got something back, like dinner tickets or merchandise, you have to state its value.
And what about electronic receipts? Are there special rules?
There are guidelines, yeah. They need all the same info, obviously. Must be legible when printed. The format needs to be non-alterable by the donor. Think PDF, not a Word doc. Needs a secure electronic signature, good security features, and has to be sent directly to the donor.
Okay. So given all that, what doesn't qualify for a receipt? What kind of payments might feel like donations but actually aren't eligible?
That's a really important distinction. An eligible gift has to be a voluntary transfer of property, money, or goods. It has to be made without the donor expecting or getting anything significant back in return. That's the advantage piece again.
Right.
It can't be directed to a specific person or family chosen by the donor. It can't primarily benefit the donor themselves. And it can't be something they were legally obligated to pay anyway.
So what are common examples of things that don't qualify?
Paying for services like tuition fees, or tickets to an event where the ticket price mainly covers the cost of the event itself. Membership fees can be tricky. If the membership comes with substantial benefits like free admission or discounts, the fee usually doesn't qualify for a receipt, a huge one. Donations of services, volunteering time, offering professional skills incredibly valuable to the charity, but you can't issue a tax receipt for the value of that time or skill.
Okay, no receipts for volunteered time. Got it.
Also, things like loans to the charity or just letting the charity use property without actually giving it to them. Those don't count as donations for receipting purposes.
So with all these rules, what are the common mistakes charities make when issuing receipts? And what happens if you get it wrong?
Well, issuing receipts for those ineligible gifts we just talked about is a big one. Or simply missing some of that mandatory information, the CRA's website address, the serial number, whatever.
Right.
Incorrectly valuing non-cash gifts. That's common and can be complex. And as we mentioned, failing to properly calculate and disclose the value of any advantage the donor received. That's a frequent error.
Backdating receipts to a previous tax year.
Definitely a mistake. Issuing a receipt when the gift was really intended for someone who isn't a qualified done, or issuing one before the donation has actually been received. Also, issuing duplicate receipts without clearly marking them as duplicate, or having someone unauthorized sign them. All problematic.
And the consequences.
They can be pretty hefty penalties. They range from 5% of the eligible amount on the receipt all the way up to 125% in cases of serious or repeated errors or deliberate misrepresentation. It really shows how seriously the CRA views the integrity of the donation receiving system. It's built on trust.
Okay, let's talk about political activities. The rules here have changed quite a bit recently, haven't they? This is something a lot of charities care deeply about. Advocacy, policy work. What's the situation now? What's allowed?
Yeah, this is a major shift, and charities really need to understand that the old rules, with that strict 10% limit on resources used for political activities, that's gone. Now, charities are allowed to engage fully in what the CRA calls public policy dialogue and development activities, or PPDA.
PPDA.
And there's no limit on how much of their resources they can dedicate to this, as long as a few key conditions are met. One, the activity must be connected to and support the charity's stated charitable purposes. Two, it has to be based on information that's factual, well-reasoned, based in reality. And three, this is the absolute hard line. It must never, directly or indirectly, support or oppose any political party or candidate for public office.
No limit on policy work as long as it's related to the mission, fact-based, and strictly nonpartisan. That's a big change.
It's huge. It gives charities much more room to participate in public debate and advocate for policy changes relevant to their work.
So that freedom is great, but that line never directly or indirectly support or oppose a political party or candidate?
Yeah.
That sounds like it could be tricky to navigate. Can you give an example of how a charity might accidentally step over that line?
That's exactly the challenge.
Yeah.
It requires careful judgment. So let's say an environmental charity publishes research on the impact of a specific industrial practice that's PPDA. Likely fine. But if that same charity then puts out a statement saying, Party X's platform will destroy the river, vote for Party Y instead, or even just tells its members which candidates align with its views on that issue, boom, that's prohibited partisan activity.
So advocating for an idea or policy is okay, but connecting it to who to vote for or which party to support or oppose is forbidden.
Precisely. You cannot endorse or oppose candidates or parties. You can't donate charity resources, money, staff time, office space to a political campaign. You can't let a political party use your charity's resources. Your official representatives can't make partisan statements while acting in their official capacity. Even seemingly minor partisan activity can lead to serious trouble with the CRA, potentially even revocation.
Wow. So meticulous record keeping must be essential here then.
Absolutely critical. You need to document everything to demonstrate nonpartisanship if questioned. Things like board minutes approving the advocacy strategy, proof of the factual basis for your positions, tracking expenditures related to PPDA, keeping copies of all materials you produce, documenting staff time spent on it. Basically, building a clear record showing the activity supports your purpose and stays away from partisan politics. And of course, you have to report these PPDA activities on your T3010.
All right. Now, many charities earn income maybe through things like a thrift store or offering services, but you mentioned business activities face restrictions. Let's clarify the difference between related and unrelated business activities.
Yeah, this causes a lot of confusion. A related business is generally permitted by the CRA. It qualifies as related if it meets certain conditions. For example, if it's run substantially by volunteers, or if it's directly linked to the charity's purpose. Think of a hospital gift shop or a museum selling reproduction.
That makes sense.
Or maybe it's using excess capacity the charity already has, like renting out a church hall when it's not in use for services. Or if the business is really subordinate to and integrated with a charitable program, maybe a training program that sells the goods produced by trainees.
Okay, those are related. What about unrelated?
Unrelated businesses are generally not permitted for registered charities. These are basically commercial operations that have no real connection to the charity's purposes. They're run primarily to make a profit, not directly advance the mission. They might consume a significant amount of the charity's resources or be in direct competition with regular for-profit businesses without having that clear charitable link. Deciding which can sometimes be a gray area, honestly. Professional advice is often a good idea here.
And what are the tax implications?
Income from a related business is generally tax-exempt for the charity, but income from an unrelated business, that might be subject to income tax. And if an unrelated business activity becomes too substantial, it could actually jeopardize the charity's registered status altogether. So tracking different income streams and classifying them correctly is really important.
Okay. Now, what about when charities want to work with other groups that aren't registered charities themselves? Maybe an international partner or a local community group. How does that work? You mentioned direction and control.
Yes, direction and control is the absolute key concept here when dealing with non-qualified dunnies, as the CRA calls them. The registered charity must maintain full control over the funds and the activities being carried out using those funds. It can't just be a pass-through.
Not just writing a check and hoping for the best.
Exactly. The charity has to be the one making the key decisions. It needs to control how the resources are used. It needs the ability to change the arrangement or stop it if necessary. And critically, the activities being funded must further the registered charity's own purposes, not just the purposes of the partner organization. You need ongoing oversight, regular detailed reports back from the partner, and you have to keep all the books and records documenting this control right here in Canada.
So just handing over money conduit funding is strictly forbidding.
Strictly forbidden.
Yeah.
You need proper agreements in place, like agency agreements. And this applies double, maybe triple, for international activities. The due diligence and documentation standards are even higher because of the added risks and complexities.
It really seems like charities need to keep the CRA in the loop about a lot of internal changes, too. Even seemingly small things, like changing your mailing address or where you physically keep your books and records, or updating who your authorized contact person is, those all need prompt notification, right?
Absolutely. Those are basic operational updates the CRA needs to have on file. But what's really interesting, and sometimes catches charities out, are the significant changes that actually require pre-approval from the CRA before you make them, not just telling them after the fact.
Pre-approval, like what?
Changing your charity's legal name? That needs CRA approval first. Any changes to your fundamental charitable purposes, amending your formal objects, adding entirely new purposes, significantly revising existing ones, all need pre-approval. Also, anything that changes your designation, say, from being a charitable organization to a private foundation or vice versa, that requires formal CRA approval before it happens.
Okay, so core identity changes need a green light first. What about changes to programs? Do you need approval to, say, start a new program or stop an old one?
Not usually pre-approval for typical program adjustments. But if you're making significant changes, adding a whole new major program area, shutting down a really significant existing program, or maybe starting international activities for the first time, you should definitely communicate those to the CRA. It helps avoid questions later about whether your activities still align with your approved purposes. It's about transparency.
And changes to governance structure, like your board or fiscal year.
Some of those need reporting or approval too. Changing your fiscal year end, for instance, that actually requires advance approval from the CRA. Amalgamating with another charity needs specific procedures and reporting. Or if a charity is planning to wind down and voluntarily give up its registration, there's a process for that involving CRA notification and approval.
Okay, let's talk about the A word, audit. Just hearing it can be stressful for charities, but you're saying being prepared is the best defense. So what does it mean to be an audit-ready organization? What should charities be doing all the time?
Yeah, audit ready shouldn't mean scrambling when you get the notice. It means building compliance into your everyday operations. So things like regularly reviewing your own practices against CRA guidance, maybe even doing occasional internal reviews or mock audits to spot weaknesses. Having clear roles, who's responsible for what in terms of compliance. Having written policies and procedures for key things like receipting, spending, record keeping.
Okay, policies are key.
Definitely. Educating your board regularly about their compliance responsibilities, dealing with potential issues quickly when they pop up, not letting them fester. And probably the most critical piece, having good contemporaneous documentation. That means creating records at the time things happen, not trying to reconstruct them months or years later for an audit. Ideally, you have solid systems in place to manage compliance overall.
Let's zero in on that documentation piece. It sounds absolutely crucial. What are the best practices for record keeping to be truly audit-proof?
Well, besides creating records in real time, consistency is huge. Use a consistent filing system, whether digital or physical, so things can be found easily. Backups are essential, digital and physical if possible, for really critical stuff. Document all your board decisions thoroughly in meeting minutes, especially anything involving finances, major programs, or policy changes. Keep signed originals of key documents.
Clear audit trails for money.
Absolutely. You need to be able to follow the money where it came from, how it was spent. And for every single expenditure, you need documentation showing how it furthered your charitable purpose. Using standard forms where possible helps. Having some internal checks or quality controls on documentation, and training staff regularly on why good documentation matters and what's required. And remember that minimum 6-year retention rule, often longer for governing documents like bylaws. Good records are truly your best friend in an audit.
And what about preparing the people, your staff, your board? How do you get them ready for a potential audit?
That's a great point, often overlooked. It starts with education, making sure everyone understands the basic CRA requirements relevant to their role, maybe specific compliance training for people in key positions like finance or fundraising. It's also smart to think ahead. Who would be on your audit response team? What are their roles? How will you communicate internally during an audit? Having efficient ways to find and provide documents when requested is vital. And maintaining institutional memory, knowing the history behind certain decisions or transactions, can be really helpful. Preparing summaries of complex stuff in advance can also smooth the process.
Okay, but even with the best preparations, sometimes charities face questions from the CRA, maybe just an administrative letter asking for clarification. How should you respond to those?
Key things here are timeliness, completeness, and professionalism. First, respond by the deadline they give you. Don't ignore it. Answer the questions they ask, specifically and completely. Provide clear, organized documentation to back up your answers. Keep the tone professional and cooperative, even if the request seems burdensome. If anything is unclear in their letter, don't guess, ask them for clarification. And keep records of all your communication with the CRA dates, who you spoke to, what was said. Follow up politely if you send something and don't hear back. Often, a prompt, clear response can resolve things quickly before they escalate.
Now, what about if a charity discovers itself that it made a mistake, maybe a compliance error from the past? You mentioned voluntary disclosure. How does that work and why do it?
Voluntary disclosure can be a really valuable tool. Basically, you're going to the CRA and saying, hey, we found this issue, here's what happened, and here's how we're fixing it before they find it themselves.
Okay, proactive.
Exactly. And the major benefit is that the CRA is often much more lenient, especially regarding penalties, when a charity comes forward voluntarily. It shows good faith and a commitment to getting things right. The process involves thoroughly investigating the problem. What was it? How long did it go on? Why did it happen? Then developing a solid plan to correct it and prevent it from happening again. It's usually wise to get professional advice when considering a voluntary disclosure, just to make sure you do it correctly.
And once you find an error, how do you actually correct it effectively? It's not just about stopping the bad practice.
No, it's more than that. You need to figure out the full extent of the problem, how many transactions were affected, over what period. Document precisely when and how the error occurred. Quantify the financial impact, if any. Put immediate measures in place to stop the error from continuing. Then, crucially, establish better systems or controls to prevent it in the future.
Do you need to fix past tax filings sometimes?
You might need to. If the error-affected information reported on past T3010s, you may need to prepare and file amended returns. And importantly, document everything you did to correct the issue. You might also need to communicate the correction to your board, maybe staff, perhaps even donors if they were affected, like with receipting errors.
This all sounds like it can get complicated quickly. When does it make sense for a charity to say, okay, we need professional help here? When should they call in lawyers or specialized accountants?
That's a really important judgment call. Definitely seek professional help if you're facing a formal CRA audit or investigation, or if there's any talk of revocation or serious penalties.
Makes sense.
Also, if you're dealing with really complex compliance issues, maybe related to intricate structures, business activities, or international work, implementing major changes like amalgamation or significantly altering your purposes, undertaking unusual transactions, any of those warrant expert advice. Even just responding to formal notices of non-compliance, developing those correction plans for serious issues, or navigating the appeals process if you disagree with a CRA decision, professional guidance can be invaluable. It often saves time, reduces stress, protects the charity, and leads to better outcomes.
Wow. Okay, that was a seriously deep dive. We've covered so much ground understanding the CRA's role, the absolute necessity of nailing that T3010 filing, managing finances properly, the very strict rules on receipts, navigating advocacy and political activity rules, structuring business activities carefully, reporting changes, and being ready for an audit. It's a lot.
It is a lot, but the core message, I think, is pretty clear. Knowing the rules and being proactive about compliance, those are your charity's best defenses. That's what allows you to maintain your good standing and keep doing the important work you do without facing unnecessary hurdles from the CRA.
Exactly. So for you, our listener, maybe the final thought is this. Think beyond just what your charity does. Think about how thoroughly you can document the why and how everything connects back to your charitable purpose, because ultimately that solid documentation, that's the real bedrock of your charity's good standing and its power to keep making a difference.